Hello. Hello, everyone. Welcome to today's session. My name is Joshua Aura. I teach financial reporting to all CPA students through an online platform. If you're interested with our courses, kindly call us through this number. This is our contact number, 0719 525,000. 0719 525,000. You'll be able to get access to our CPA online platform, which will give you access to all our videos, plus a timetable to which days we normally have the live Zoom classes. Welcome. So today I would want us to look at something very simple, which is computation of goodwill in group consolidations. How do we compute goodwill? Now, ladies and gentlemen, first of all, it will be very important for you to understand that goodwill represents what we call the premium on acquisition. The premium on acquisition. So when a parent company is buying its stake in a subsidiary, of course, whatever amount it will pay, if this subsidiary is a nice company, whatever amount they will pay to the existing shareholders of the subsidiary for them to exit, the amount to be paid, of course, will be higher in comparison to the net assets of that subsidiary. So look at this. They're paying more than the net assets of the subsidiary. This excess amount which they have paid over and above the net assets of the subsidiary is what we are calling goodwill. And for us, we have a simple example here that I would want us to go through, which will really enable us to understand how this goodwill is computed using the two famous methods. So we are told here, a parent company buys 75% of the equity shares in a subsidiary company for shillings 156,000. The remaining shares were valued at shillings 52,000, and the net assets at acquisition were what here? 170,000, worth 170,000. So they want us to calculate goodwill, assuming that NCI, which is non-controlling interest, is measured using fair value. Goodwill, assuming NCI in the second scenario is measured using the proportionate share of net assets method. Now, ladies and gentlemen, I would want us to just go slow on this. This is quite an interesting area. Very interesting area and easy area, which can make you get a few marks for you to be able to pass your CPA or ACC exams. So goodwill computation, number one, is what we are calling, or rather when we are measuring NCI using fair value. Using fair value method is also what we call the full method. Full method. How do we go about this? Very easy. Number one, we look at the purchase consideration, of the parent, the parent's purchase consideration, the parent's purchase consideration. So the parent paid how much for its stake? We are told a parent company buys 75% of the equity shares in a subsidiary company for 156,000. So the parent gave 156,000 for its stake there. So remember, the parent never bought 100%. The parent never bought 100% of this company. They only bought 75%, meaning that there is another stakeholder who came and purchased 25%. Now, because we are told the parent got 75%, the other stakeholder, of course, will be the NCI. So in this case here, come and give us the NCI's consideration. The NCI's consideration is what they have told us to use fair value. Fair value basically represents the market value of the shares on acquisition. On acquisition, we are told the remaining shares, of course, which are 25, were valued at shillings 52,000. So the NCI's consideration, which is the fair value of their shares at acquisition, was 52,000. So when you add the two, what are we going to get here? We have 0, 0, 0, like that, 8. This is 0. This gives us what here? Somebody 208,000. 28,000 is the total consideration that was paid by the two parties. So remember, we are using full method. Full method here, we are using fair value to evaluate the stake of the NCI, the non-controlling interest, the value of their shares at acquisition, their market value at acquisition. So that gives us 28,000. So come and compare now these with the net assets. So less net assets of the sub, less net assets of the sub at acquisition. Net assets of the sub at acquisition, we are told, under the net assets of this subsidiary at acquisition was 170,000. 170,000, you subtract like that, whatever you will get will be called goodwill. Goodwill at what year? At acquisition. Goodwill at acquisition, which will end up giving us what year? 38,000. 38,000. So just like any other asset, remember goodwill is an intangible asset. We expect this to lose value with time. Value lost will be called what year? Impairment loss. So you're supposed to come and calculate the impairment loss if you're given a policy as regards that. Of course, there is none here. So that when we take off the impairment, less impairment loss, which in this case here, there is nothing given to us, then we should be able to get what we call goodwill. Goodwill at what year? Goodwill at reporting, which will be 38,000. Now, this is what I take to my consolidated statement of financial position under non-current assets and non-current assets. So I hope this is clear. And if it is clear, then allow me to look at the second method. The second method here, where they want us to value NCI using their proportionate share of net assets. Now, ladies and gentlemen, everything here else remains the same. So number 2, now we are calculating goodwill, but this time round, looking at the concept of proportionate share over NCI's assets, net assets. So the parent's purchase consideration that remains. So what I need to do is to come and pick the NCI's consideration here, which this time round is proportional, is a proportion of their net assets. So remember, the parent company owns what percentage? 75%. So 25% is what is being held by who? 25% is being held by who? So 25% is what is being held by NCI. So it will be 25% of the net assets of the subsidiary. Now listen here, just as we did with the other one, less net assets of the subsidiary. The net assets of the subsidiary here, if you remember very well, the net assets of the subsidiary were worth 170,000. So it is these net assets of the subsidiary which are worth 170,000 that will come and calculate the NCI's share, 25% of the subsidiary's net assets, 170,000 like that. So come and give us 25% of 170,000. Using your calculators, you should be able to give us 25%. You should be able to give us 25%, 0.25 times 170,000, which gives us 42,500. So this gives us 42,500. Please add the 2 for you to be able to give us the total consideration. So plus 156,000, which gives us 198,500. 198,500. So less this 170,000 for you to get goodwill. Goodwill at acquisition. So goodwill at acquisition, so minus 170,000, that gives us 28,500. 28,500. Goodwill at acquisition is 28,500, of which if you would want to get goodwill at the end of the year, goodwill at reporting, you need to less the impairment loss, which is not given here. So basically, goodwill at acquisition will be the same as goodwill at what year? At reporting. So that is all that I have for you for today. Please don't forget to subscribe to our CPA courses, online courses. And remember, I gave you a number. I gave you a number that you need to call and get in touch with us. Thank you very much. Be blessed.